Hello, everyone. Welcome to today's session. Thank you for joining us on such a exciting day. And I'm Shalini Gautam. The most awaited outcome of the year is finally here. The verdict is out, and NDA is leading in roughly around 272 seats. But the extent of the victory is not clear, and its lead narrower than what exit polls had predicted. Markets had been expecting an outright victory for the NDA for the next cycle of growth. Equity markets so far in the last 1 year had a good run up. And we want to now understand, does the silver lining extend further, or it could be clouded by uncertainty given the current scenario? Today we have Shreyash Devalkar, Head Equity, and Devang Shah, Head Fixed Income, decoding the way forward post elections. Before we start, I want to briefly introduce both Shreyash and Devang to you guys. Shreyash heads equities at Axis, and before joining Axis in 2016, Shreyash was associated with BNP Paribas Asset Management as a fund manager. He's also worked as a research analyst at IDFC Asset Management and IDFC Securities. Shreyash is a chemical engineer from UD and has done his MBA from Jamnalal Bajaj Institute of Management Studies. Devang is the head fixed income. Before joining Axis in 2016, Devang was a fund manager at ICICI Prudential Asset Management and an analyst at Deutsche Asset Management. Devang is a chartered accountant. Before we begin and start with a round of questions for both of them, I would urge all of you to use a chat box and ask any questions you may have. Shreyash and Devang, welcome on board and thank you for taking time out for this session.
Thank you.
So I'll start with Shreyash first. Shreyash, tough day today for the markets, tough day today for NDA. How do you decode the markets today and the government today?
Sure. Obviously, when it comes to equity market, is always about expectations and how the trade was set up over last 3 to 6 month time period. It's not about last month or so. If you look at it, it's more to look at to do it with last 3 to 6 months. And the way it was getting positioned, the trade and the internals of the market. If you look at the way just the day prior to today, that is till yesterday, the movement in the in mid caps, especially the movement in the PSU as a pack. So a couple of those indicators definitely was suggesting, and especially the moment in some of the investment oriented sectors. So there was a heavy positioning definitely in PSUs. There was a heavy positioning in capital goods and investment oriented stocks, and that has been the setup. And that's where the expectation of the market is around those aspects of economy. So with this development, again, as of now, still the clarity is yet to emerge. But till now, whatever data points are there, the market would be more keen to watch out for the developments around this, especially investments in the infrastructure sector and policies around PSUs. And again, every PSU has a different nature altogether. So there are companies in banking, there are in defense and rail and etc. power sector. So there are expectations around this segment, and market will watch out for how the policies evolved in these segments.
Okay, perhaps it will be early days till we figure out what happens next. Devang, bond yields saw a big jump today given the uncertainty about the government. Do you think fiscal consolidation trajectory may be impacted if the government has a weak mandate?
Thanks, Shalini. So first of all, I think what was bond market looking out for in this election results? I think to start with, firstly, they were looking for if we would have got a complete majority. Okay, I think the general expectations were that probably we'll start looking out for a way for fiscal consolidation. So market were expecting. I'm sure you all recollect that RBI last month, announced a significant big bonus for the government. It was a surprise gift in a way of 2.1 trillion of RBI dividend. So the general expectation on markets, specifically on the bond markets, were that this would help government to actually reduce borrowing and probably pave their path for fiscal consolidation. Also, S&P upgraded the outlook for Indian ratings. And the combination of both, I think probably this entire surprise of 1 trillion additional dividend, as well as the outlook change. Our perspective was that if we probably would have got the majority today, we would have been very happy, the bond market specifically, and would see some rally in bond markets. Yes, the outcome has been a bit weaker. We today still NDA is a majority, but I think probably a BJP majority would have given a significant bounce to bond markets. The impact on yields has been 10 basis, and our perspective is now all the eyes would be on budget, where people would look out for one, if there are any schemes, welfare schemes specifically, which are announced. Is there any significant change in the outlook on budget, whereby they increase a bit of expenditure and the entire fiscal consolidation path, which we were all talking about, that this additional dividend could have led to the cut in fiscal deficit from 5.1% to correspondingly around 4.9% this year, probably might get delayed a bit. So I think from bond markets perspective, yes, today we saw around 8 to 10 basis of sell-off across the curve, but NDA broadly being in majority, and we believe that if the current government comes back on in power, we probably see bond markets trading in at current levels, and we would be watching out significantly on the impact of all this on the budget.
Okay. Shreyash, domestic and global investors are anticipating an aggressive set of reforms, which can put India into the next orbit of growth. I know you have been saying a lot that we are in a multi-year cycle. How do you see this cycle playing out? In particular, what sectors do you think will be in focus? And also, if you could let us know about your positioning.
Sure. That remains that India is definitely in the multi-year cycle. If you look at individually the sectors and the data points around. So when we look at multi-year cycle, there are multiple elements to it. So individually, what sectors and where are those in the cycle? And when we try to associate with the election outcomes, what impact it may have, and what impact it had in last cycles as well. It is not about this. So if you go back in 2014, even in 2019. Every time the setup has been different, and every time the expectations has been different. While when it comes to the broader trend and economic cycle, they have continued wherever there is a tailwind as such. Now, in this broader context, if you look at current cycle, and if you try to break down on multiple aspects of it, and my comments are more restricted to the listed equity space and the listed corporate outcome rather than the overall economy. That I always would like to give a caveat on this. So then when it comes to the listed space and the cycles which are happening and where we see things to progress and whether we are in the multi-year cycle, then definitely what we have seen is on the consumption part of the economy, the discretionary and consumption which is more discretionary in nature. There we have seen a good cycle. In our opinion, that cycle for various reasons is continuing, and I don't see any reason why it should not. There is an expectation that even the FMCG or the goods where we have seen that the cycle has not been that great when it comes to the FMCG consumption. Here there has been some reasons. Some of the reasons has been bottom up, individual company wide, or some of the reasons has been around spend. So with this kind of election outcome again, and again there are state elections ahead. So one may expect a certain spend on the consumption as well. So it is too early to conclude anything, but it's always a possibility in this scenario, and that's where one need to watch out for that space. That whether there are and especially budget in that context will be very interesting to look forward to, so that trend in the consumption, whether there are any changes in that cycle, which has not picked up actually in last 4 or 5 years, the consumption, especially in the FMCG space. Coming to investment part of economy, definitely multiple project announcement, multiple policy initiatives which were taken. The policy initiatives were in Make in India. The policy initiatives are more driven by export orientation as well as import substitution. So, in my judgment, import substitution related policy initiatives may continue further. We will have to see in the EMS space where a lot of actions were done, and we have seen a great development in that part. So those parts where there is a development on especially Make in India basis, and those policy initiatives where the process is always already on. I think those policy initiatives may continue. When it comes to the bigger segment, especially segments like power, where there is more a need, and again, any economic cycle which is more driven by the need than just and then geopolitical impact. So, like export substitution, etc., is those policy initiatives were also driven by geopolitical development worldwide. While when it comes to power sector capex, infrastructure is a necessity, and it's not only in India. So worldwide, the power sector capex cycle is doing well because of change in the energy consumption patterns, change in shift towards renewable energy, and so on. So those part also, I think there is a possibility of that part getting continued. Uh, the only part where we have been negative for some time is the export part of the cycle. And in the export part, definitely our expectation has been that yes, there are certain pockets where there is slowdown already, certain segments like IT, already certain segments like capital goods exports, etc. Even auto ancillary exports, they have shown signs of slowdown. So that part again is more to do with the external environment, and that's where that has been the cause of worry for us. So in the investment, yes, there are the segments which are more where the policies are driving import substitution and all. There we need to watch out for the how the policy shapes up further. So every subsegment has its own cycle rather than calling out one thing. So in consumption, it will the spend pattern, how it will emerge in policy, especially when it comes to import substitution. There, how the policy further shapes up, that we need to watch out for.
Okay. Over to Devang now. Devang, you spoke about how the economy is so robust, and the S&P rating upgrade as well as the GDP numbers also paint a very good story about India's economic growth. Do you think with this robust growth, the rate cut cycle could get delayed in India?
Yeah, so see, if you ask me, actually, central banks across, you pick up US growth data, you pick up Indian growth, I think probably central bank across the world today would not be any kind of hurry to cut rates. We have already seen these kind of inflationary pressures resurfacing, and we have like a lot of a heat wave probably which can impact the veggie crop. So our perspective is very clear at this point of time that RBI will not be in any hurry to cut rates. RBI will look at some point of time in the near term the impact of monsoons, and probably in the second half of the year start looking at the rate cut cycle. I would also like to allude on the point that I think a lot of discussion last year was about the interest rate differential between India and US. And I would like to point out that US is going through a different cycle altogether, both on inflation and fisc. We have not seen such huge fiscal expansion anytime in US economy over the last 15, 20 years. So the perspective on the differential between India and US no longer stands. Also, if we actually see some bit of growth slowing in India, which we have started seeing, obviously these are real high frequency indicators which have started to show some bit of slowdown in the near term. If these continue and somewhere we see some bit of slowdown, RBI can look at cutting rates even before Fed. So the point we're trying to put across is, yes, in the near term, no hurry for central bank to cut rates because growth story continues to remain strong. But on a medium term, if we meet the inflation target of 4%, monsoons are good on track. The real rates today in India are quite high. Like you have the operative rate at 6.5. If your inflation is tracking close to 4.5, 2% real rates are quite strong for RBI to start looking at the rate cut cycle. So we what we believe is that in the near term, in this monetary policy, RBI will be on status quo. We don't expect anything from RBI, but in the second half of this year, probably bond market participants can look at 25 to 50 basis of rate cuts.
According to you, Devang, which will be the first central bank to lower interest rates? It is definitely not the Fed. Do you think it could be the UK or the European Central Bank who could be lowering interest rates soon?
So our perspective is yes. If you look at European data has been a mixed bag and have started showing significant slowdown. So we believe that ECB can cut rates before Fed, but to everyone's surprise, even US data started to show some signs of weakness. In the Jan and February data was significantly strong. The first quarter was very strong. April onwards, the trend on US data has also started to weaken. So our perspective is if data continues to remain the way it is, even Fed can start looking at rate cuts in September policy. So it's a close call. I would say yes, European Central Bank as well as Fed both can start looking at rate cuts in the next quarter. Our perspective on when it comes to Indian Central Bank is that they would want to be cautious before monsoons. They want to be sure about the Indian inflation reaching the 4% inflation trajectory and then start looking at rate cuts. And that might be in the second half of this year.
Okay. Thank you, Deva. Shreyash, I wanted to ask you about the most important question that everyone keeps asking about is India's valuations. And it's always been the fact that in the last 1 year, we are pretty expensive valuations compared to China, South Korea, or other emerging market countries. What do you have to say about that? And how should investors look at these valuations when they go about investing?
Sure. So, as far as valuations are concerned, again, India and valuations are high is nothing new. So, always that has been the case. Only the extent has changed. What standard deviation above the historical mean is what we normally tend to track. And in that context, if you look at the large caps, especially large caps which are dominated by private sector banks, they are dominated by FMCG, dominated by IT sector. Because of they being dominated by these sectors, generally, and you must have noticed that the valuations in this sector has not got re-rated big time, the way a broader market has got re-rated. So when it comes to the headline markets or the large caps, so to say, the valuations are in that context, in our historical context, they are not really high. But yes, when it comes to the broader market, the valuations are high. And that's where it also got reflected in the returns also in last few 4 to 6 months. So if you notice, actually, even as of yesterday, if you would have done this analysis, then you would have noticed that 3 month, 6 month basis, actually, large cap returns are same as small cap returns. Only mid cap returns are higher because mid cap has a lot more PSUs by weight in that segment or in those indices, which has performed a lot. But the because the valuation differential was getting too high, already large cap has started performing in line with small cap, if not underperformed the way it used to happen 6 months before. So that way, valuations from a domestic investor point of view, definitely when it comes to relatively compare large versus mid versus small, definitely large cap, which is dominated by the three segments which I talked about, the valuations are not way higher than their historical pack. Now, when you come to the other segments of the market, which is mid and small cap, wherein these segments are dominated more by investment part of economy, there definitely valuations are high, and I think there are enough cautions. I think even everyone is talking about for now some time in this space, more because of the valuation. Again, when it comes to earning growth, definitely earning growth has been higher in this space, and that's where the valuations went high. But But all in all, since we are talking only on the valuation, then definitely this is the space where the valuation compared to the historic average is definitely higher. So when it comes to the international investors, definitely India's weight in the global MSCI and the benchmark indices is going up. It's getting closer to 17 odd percent, and that's where definitely international investors are looking at India. So when it comes to these three segments, so and that's where I always come back to what exactly you're looking forward to, rather than making a blanket comment on it. When it comes to large caps, then the segments which are dominating the large cap, definitely there is good valuation support attached.
Thank you, Shreyash. So I also want to check with you. The FPIs have stayed on sidelines this year, and in May itself, we saw outflows to the tune of $3 billion US
Hmm.
dollars. In contrast, DIs have been buying. Do you think, given the way the valuations are, and now the way the situation on the government is, FPIs may sit on the fence?
Uh, See, even earlier, so if we just look at FII flows has been choppy over last 1.5 year. There has been pockets of few months where it came in, then it went out, and then came in. And when it comes to their call, has been most of the time has been dependent on the relative valuation one, uh, on which they anchored their call on, and especially the relative valuation as you are highlighting, not only versus Indian mid cap, small cap, but more to do with the regional valuations in that context. So that is one factor for them to invest in India. Second factor is definitely currency stability and the interest rate differential and currency stability, since they are interlinked parameter. And we have seen very high correlation of FIF flows to this parameter. You take right from rising interest rate cycle, which started in October 21 till now. The FIF flows has been highly correlated to this parameter. So when it comes to now, since we are bringing in all in this conversation, we are just trying to correlate FI flows only with the election outcome. But if you now look at in the overall context, and that's what one need to bring in. So one is the relative valuation, which pockets. Secondly, interest rate differential, currency stability, and most important is the weightages of Indian indices in global benchmarks and their ownership structure. Considering these all these three parameters, I think that FIIs will be selective, mostly on the large cap space of India. That's what is expectation, considering these three factors as such, because you have to consider the relative valuation comfort, you have to consider the stability of currency, it's more of a macroeconomic nature, and thirdly on the specific segments where you expect a growth.
Okay. Deva, India is at the cusp of FPI flows via JP Morgan indices. What are your views on these?
So, see, our perspective is, first of all, we all need to understand that around 50% or more than 50% of whoever is tracking the JP Morgan indices, the investors out there, are all passive in nature. So, they would be, in fact, more happy with this sell-off, because actually yields have gone up. So, it would be good time for them to start investing and replicating the weights. As per the index and the inclusion, they need to add 1% weight per month and probably move the allocation from currently almost 0 to 10%. The expected flow is approximately 2 billion per month. If you have seen, we have already got some 8 to 10 billion of FII flows in India, and some might be through active fund managers, active investors, some hedge funds. We already got some FPI money in India to the tune of 8 to 10 billion. Our perspective is that when we look across at both combination of passive investments, the high yields, and the macro hasn't changed for India. If you look at from a macro perspective, we still are moving towards a lower inflation trajectory. The demand supply dynamics in India continue to remain favorable. As I told you, in the near term also, we'll all be watching out for the budget, but we were expecting a cut in borrowing programs. I don't think so there will be any additional borrowing which will be announced. With those numbers also, I think the demand supply dynamics for bonds remains quite constructive and very favorable. And hence, our perspective is that FI investors will continue to participate and increase their allocation to Indian bonds. Largely being passive, our expectation is 1 to 2 billion of flows will start from this month, and we should see approximately 50 to 20 billion of flows coming into India, additional to the 8 to 10 billion already come in the next 9 months. So by March 2025, we expect another 50 to 20 billion of flows flowing into India.
Okay. Yeah, you spoke about inflation, which brings me to my next question, which is that this year we expect a better monsoon from El Nino to La Nina. What are your views on inflation? Where could it head, say, in the next couple of months?
See, we try to do some stress testing on inflation on all fronts. Like if we see some pickup, I'm sure everyone have noted that in the last quarter, thanks to some uptick in China data, some bit of, I would say, impact of geopolitical reasons, we saw a significant uptick in base metals, oil, and precious metals. We tried to do some stress testing and add this to the core inflation. How does the core inflation move? We also did some kind of delayed monsoon and impact of that on veggie and food prices. And lastly, a reversal of bit of house inflation, because in the core inflation, one of the biggest disinflationary reason has been in India, the housing inflation, which has been at to sub 3%. So with all this stress testing and reversal also, we don't expect the headline inflation to move significantly higher. I think currently it's tracking around 4.5, 470 band. The next quarter, actually, because of base effects, will be significantly lower than 3%. Our assessment is on a worst case scenario in the next 6 to 9 months, we don't expect inflation to move above 4.5, 475 band. And with that trajectory, I think that's another reason why we believe if monsoons are good, RBI can actually start looking at reducing the rates or actually changing its stance in the second half of this year. So inflation trajectory is significantly under control, and with some kind of stress also being added, we don't expect the next 9 month inflation averaging above 475.
Shreyash, the most important trigger is now out of our way. What are the next big triggers according to you?
Actually, in investing, it's always said that don't look at the triggers per se. Look at the companies and how they are growing, and so on. And that's what, at least on that front, it's a good release that yes, you are back to the basics, rather than just a one-way street of by a certain sector, by a certain theme as such. And that's where I think the market is going to be back to basics on the bottom-up basis. Normally, when such an event is behind, normally what it is in that generally the excess valuations gets corrected, and the excess valuations go to the normalized level of valuation. So that process probably in one day it is seen, and I would say that again as of now the final outcome is yet to emerge. But point is that since the event is behind, and mostly as I said that our view on the various policy fronts, in my opinion, the narrative-based or the thematic way of re-rating which has happened, some part of it has reversed, and probably some part of it may normalize irrespective of outcome, and then we are back to individual companies how they are doing. So here on. My judgment would be that specific companies in each segment we need to look at on a bottom basis. So this is the right time to go back to the bottom up basis stock picking, and it may actually give you better results as far as investment outcome is concerned, and more sustainable returns as far as investment is concerned.
Okay. Devang, how are you positioned currently?
Oh, so we have been actually guiding markets since December to be long on fixed income, and the thought process was threefold. I think the entire macro dynamics, which I explained, probably at this point of time, we are not only expecting a lower inflation trend, but somewhere down the line, significant stability in the external sector, and that continues. And JP Morgan flows actually add to our external sector stability. We've got 20-30 billion of flows on the debt side, significantly takes care of the near-term volatility on FPI flows and other aspects, which she has pointed out. So I think from a macro perspective, with inflation trending lower, external sector stability, there was an addition which was more tactical for this year is this actual inclusion of JP Morgan R bonds in JP Morgan indices. Fiscal cut to the tune of 0.7% in the budget actually paved the way for going significantly long on the bond side. So we have remained constructive on rates and today also, and we continue to remain constructive with it at this point of time. As I told you and highlighted, I think probably what markets were expecting from this budget was much more on fiscal consolidation because, sorry, not budget, I'm talking about the election results, sorry. From the election results, market were expecting more on the fiscal consolidation path, where if we get a majority, there's a high probability of borrowing cut, and which can actually lead to more rally in bonds, which I think might get delayed. But at this point of time, at an absolute yield of 17, 715 levels for 10-year GSEC, I think looking at the macro, looking at the inflation trend, the demand supply dynamics in India doesn't change, and we don't anticipate any significant increase in borrowing in the budget. So at max, we might not see further fiscal consolidation, but our view continues to remain at this point of time that we might not see any additional spending also, or an increase in fiscal deficit in the budget, which will be announced next month. So keeping that in mind, we continue to remain long, and we would advise client to stay invested into short to medium term categories and having some tactical allocation in gilt funds.
What are the risks to your view, Devang?
So, if you ask me, I think if I'm looking from a macro perspective, INR has remained quite in a short band or a short range, and there's been a lot of stability on currency, as I explained, because of flows, current account deficit significantly reducing. We have started looking at other emerging market currencies getting significantly depreciated, and if you look across at Chinese yuan, Indonesia rupiah, Japanese yen. Okay, the other currencies have shown some bit of depreciation. If we see some INR depreciation, that can actually put some brake on Indian bond market yields. The second risk, I would probably assign a lower probability, but if, as I told you, that we have got a lower majority now, and it is somewhere down the line, all eyes would be there on the budget. Our view is that we would not be having any significant increase in borrowing, but for some reasons, if we see an increase in borrowing, I think markets might see some bit of volatility in the near term, and yields can inch up to back to 7-quarter levels. So I would say two risks. One is currency depreciation, and secondly, if there is an increase in borrowing in the budget, which is next month, we might see some volatility in bond yields and possibly a 7-quarter on the 10-year levels.
Okay. Thank you, Devang. Shreyash, I wanted to check with you. In the last 1 year, you have been bringing down the concentration in your funds, and now it is pretty much down. Would you want to talk about how you have been positioning your funds in the last 1 year?
Yeah, so last 1 year, you would have seen certain changes in the fund, especially our four funds more so. And actually, it has happened across the board. When it comes to concentration, yes, the four funds have seen a drastic reduction in the concentration levels that we have driven by design, and it is broadly there. We have also seen, especially in last 3 to 6 months, in we have maintained. So obviously, on one side, we got hurt because of our lesser exposure to mid and small cap space. So in the funds where we had less, we actually kept lesser. So if you look at say blue chip fund, it is it remains a pure play large cap fund. So we have not increased exposure to mid or small. We have just kept it large cap oriented, and its concentration level has gone down, and it is actually spread across other sectors. When it comes to both blue chip and as well as the long term, both actually the similar case. Long term having more mid cap historically always. There also we have just maintained it. We have not just increased it. On the other hand, if you look at our multi cap fund, it actually had more small cap. We actually maintained their 25% small cap and mid cap per se, and 50 remaining large cap. So we have been cautious on this space of mid and small cap, and we have maintained those wedges over last 3 to 6 months. So broadly the changes are in this direction.
Thank you, Shreyash. Any risks to your views? What are the risks in terms of equities for investors?
So yes, so when it comes to risk, one is valuation risk, and the other obviously is the expectation, which get excessively built up in the. That's where I spoke about. If you go by the basic metric of what has done extremely well in last 3 to 6 months, there are two pockets definitely where it has done extremely well, and the expectations are high. So in that context, it will be very interesting to see the budget wherein the balance between investment part of economy, investing into it, which government has rightly done so far in last 3 to 5 years. Secondly, also trying to spend on the consumption part, so the balance between the two as well, and then obviously balance between these two and fiscal deficit. So that will be crucially watched out for in this budget to come, and that, in my opinion, will be one of the key elements which all investors will see, and that remains if the balance is not in line with the expectation, then definitely you may see some you may see risk in some part or other of the market, because market is positioned on the investment more, and the expectations now would be spent on consumption as well, and that's where one need to look it. Secondly, as far as risk is concerned, definitely the global risk persists. Globally, we have seen some drastic movements in both commodity, which is expected to affect margins of Indian companies definitely if it persists, and that's where both currency as well as the commodity price drastic movements that has the impact on Indian listed space, where the commodity inflation will be seen. So it will be seen 1 or 2 quarters down the line, though not immediately, but yes, that remains one risk, and one risk which we have been highlighting always, which is of exports slowdown, and that remains.
Okay. Thank you, Shreyash, and even thank you, Devang. Before we close this conversation, I want both of you giving your opinion on your advice to investors. Should they proceed in these times? Shreyash, first with you, and then with Devang.
Yeah, so actually, I would treat election as an event which obviously it repeats after every 5 years, and we have seen multiple outcomes after every election result when it comes to equity markets and the way economy pans out. In that context, if you just look at whatever drastic movements which happen, which is pre-positioning to such an event, and even post-positioning, unwinding or further trend up, whichever is the case. The net outcome is that the undercurrent and underlying economy, if it is doing well, then generally you end up getting returns from the equities, and those returns are definitely not as high as what we have seen last 3 to 5 years. So one need to look at the normalized return of last 5 to 10 years, where we have seen that nominal GDP growth plus minus returns is what is expected. So I think the investors need to have that kind of expectation that yes, nominal GDP growth for plus minus returns over a longer period of time, and not focus too much on the recent returns and anchor their expectations around it. So and in that context, equity market has given good returns as such. So such events over a longer period of wealth creation generally have a lesser impact. Normally.
Devang, what about you?
Yeah. So, see, what I believe is, we have been highlighting, I think this is a year probably where fixed income markets or returns will be quite good from fixed income products. And that's largely because of the macro parameters. And I listed down, I think, the falling inflation trend, the external stability. We are in the peak of the growth cycle with the peak of the interest rates. So from a fixed income market perspective, we don't see immediate any kind of risk as I think she has also highlighted. I think yes, from fixed income market perspective, election results do matter because what would be the impact of that on the budget and the borrowing plan? Our view out there is that we are still getting, we believe that the outcome is still not certain, but we believe that if ND is coming in majority, there will not be any significant change on the borrowing plan. And they will probably continue with the same fiscal deficit number which they have highlighted before. With 5.1 fiscal deficit for the year, because of our bonds getting included in JP Morgan indices, the demand supply dynamics are very, very strong. So even if we see a bit of the delay in a rate cut cycle, we still remain constructive on bonds and would advise our clients to stay long in fixed income at this point of time. The choice of funds, as I highlighted before, should be short to medium term funds with some allocation to gilt funds, which is what at this point of time, looking at the macro parameters, looking at the demand supply dynamics, is what we advise to clients.
Thank you, Devang. Thank you, Shreyesh, and thank you, Devang, for joining us and giving us these insights. And thank you to all our distribution partners for joining us. Have a good evening.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.